All right, check, radio check. You have not been on these calls in a while. Format is we do these every week since COVID had hit. If you have a question, you'll see my contact information afterwards. We're not selling anything here. Leave your wallets at home, leave your checkbooks at home. We're really here to provide value on a continuing basis. And the reason I started to go down this path is you're going to see this is a 4-part series that we put together. After the last couple of calls that we did on structured notes and on, ARC as satellites to some of the investment philosophies, I got a couple questions like, what is yield? I was a little into the weeds there. So I started thinking to myself, I'm 56 and I learn something new every day. And one of the things that I recognize by speaking with a lot of folks over the years is sometimes I will ask a question genuinely. People have an idea how they work, but maybe they can't articulate it, maybe they get the concept. So what I wanted to do here today is take us through core investment theories. Today's topic is going to be on stocks and bonds, but you're going to see we've broken this up into 4 segments or sectors. And it may be over 4 weeks, but once a month, I also like to do a market update from the previous month. So I might stretch this out to be like a 5-week. Today is going to be on stocks and bonds, but next week will be on unsystematic and systematic risk. And then now I've been talking about this, but I wanted to build upon the first 2 topics in order to be able to do a deeper dive into the milk cow and the hunt for yield. And then ultimately a topic of a strategy that we were introduced to, tornado warning versus a tornado watch. And, just some different strategies that we now have access to that maybe you might want to take a look at. So without any further ado, risk management, developing a plan. Long-term investors, what do they want? Well, 1, they want to be comfortable. And 2, to generate the highest possible compounding returns, right? But the keys to compounding returns is to avoid risks in substantial portfolio declines, limit portfolio volatility to normal fluctuations, and then achieve true diversification to better manage risk. Brookstone bought Formulafolios, and they have an acronym. It's called RAISE, Risk Appropriate Investment Strategy Evaluations. That's a fancy way of saying that, when you get those risk questionnaires, depending on how you feel, and when you're a married couple, one person might be a little bit more aggressive and the other person not so much. So, it really is prudent to get a good sense of what you're comfortable with, because I can tell you over the years, the one thing that I really want to make sure is we never want clients to lay in bed staring at the ceiling, awake at night going, am I going to be okay? So types of investments. Basically, at its core, there's 2 ways to invest: loaning money or owning an asset. So for loaning money, you can invest by loaning your money in a variety of ways. The borrowers promise to pay back the principal amount invested and pay the interest agreed to you in return for the use of your money. Now, there's basically different places we can loan our money to. We can loan it to a bank, we can loan it to the government, or we can loan it to a corporation. So banks, we're familiar. If we loan them our money, they're going to give us a CD, a certificate of deposit, or maybe a money market, or maybe they're going to issue mortgages, right? That's what they do with the real estate, and savings accounts. These are all vehicles that the banks have traditionally done over the years that we consider that safe money, right? Now the government-backed bonds, bills, notes, back in the day when they still had 𝗕𝗠 savings bonds, these were ways for us to lend money and get some type of predetermined rate of return on a vehicle. And then corporations, and this is where, you have investment grade bonds. When I say investment grade, I mean, these are your larger, more established, your Coca-Colas, your Johnson & Johnsons, your Pfizers, your McDonald's. Those companies, sometimes they want to use your money because they might need cash, so they'll issue a bond, but they don't want to necessarily dilute ownership of their company. So it's just a different way to invest. And then obviously, and I've said this in the past, high yield bonds. So high yield means above average rates of return. So in today's economic world, if you're getting between 7 and 10% promised from a corporation or higher, that's considered high yield. Well, if we're going to get high yield, then it's traditionally can be above average risk. And we're going to do some deeper dives on this, but I want us to understand the core of what a bond is so that when I start to talk about it, I've been talking about this for years now, starting to seek bond alternatives. But in order for you to understand why this is so critically important is because if we keep doing what we've always done just because it worked, it may not work on a go-forward basis. And that's the reason why I decided today I wanted to just really just drill down onto definitions and making sure that we understood. So when we're lending money to a particular entity, the most common way to do that is in the form of a bond, right? They get CUSIP numbers, they're traded on Wall Street, and the characteristic is that it's a debt instrument, that the investor loans the money to the entity for a defined period of time. So meaning that it's predefined terms. The interest rate is typically fixed. It's used by companies, governments, states to finance a variety of activities, right? So whether they're buying, there may be a corporation's expanding, they want to buy some new buildings or purchase some new equipment. You have revenue generating bonds or GO bonds. You know, these are maybe projects within the government that they needed capital. And states, you know, Turnpike was funded by bonds, you know, any of these types of things are reasons that states, governments, and companies might need to borrow money in order to finance projects. They're often referred to as fixed income securities. And the reason is because if you're going to lend somebody money while they're holding your money, you want them to pay you along the way. And that's that income that can be generated from it. So defining the terms, when we talk about a bond, this is where, you know, just understanding that there's a few definitions we have to become familiar with. I say them every day, and just because they might flow off my tongue and I go, oh, and you might, overall you get it. But if you're not in the industry every day, somebody says something and sort of you start going, what's that mean? So I wanted to, again, slow down, just talk about definitions. So when I talk about par value, right, that's the amount the bond will be worth at maturity date. Typically, that's the face value of your purchase price. So if I turn around, typically bonds are sold in $1,000 increments, $10,000 increments, could be $100,000 increments. If you give a corporation $1,000, I want my $1,000 back. Now, when I get that back, there's a period of time as to when I want that back. So the maturity date, right? So it could be a 10-year bond, 20-year bond, 30-year bond. The term, that's the length of time between the initial issue date of the bond and the maturity date, right? The yield, so this is the annual percentage rate or the return on investment. And then coupon date, the date on which the bond issuer will make interest payments to holders. Now, bonds typically, so let's say it's $1,000, it's a 5% bond, so that we know 5% will pay off $50 a year on $1,000, right? So $50, you're going to turn around and get payments, but they typically pay semi-annually, right? So you're going to turn around and go, okay, I'm going to get every 6 months, I'm going to get my coupon. And then the coupon rate is the stated rate of interest being paid on the issued bond. So the majority of bond purchases are made after the origination date. So it takes a while. If you've never seen a bond, I mean, they are 2 or 3 inches thick. They are quite sophisticated. They take time to generate. And then like stocks, bonds trade through exchanges, and bonds are originated based on a couple of primary factors. Credit quality. So just think about your credit score, right? You know, if you pride yourself on having a high credit score, right, that means that you pay your debts. Well, the same thing goes for if you're going to lend money to an institution, you want to make sure that they in the past have generated good credit, right? So a poor credit rating increases the risk of default. And this goes for both corporations and municipalities. Poor credit may involve higher risk, leading to higher interest payments. That's why you're getting that high yield. Now, duration of the maturity, typically the longer the length till maturity, the higher the rate. Now, I was just looking this up before I hopped on this call. And so a 10-year bond right now, you see all over the news, CNBC, right, that we've been approaching on the 10-year bonds, might be approaching the 2%. And remember, as yield starts to go up, right, prices drop. And you'll see that here in a second. But right now, it's around 1.6% on a 10-year note. And then, you know, a 30-year bond is maybe 2.2, 2.3%. So when you start looking for places to put money, right, in a low interest rate environment, this has been my concern for a while, is that we're going to put our money, our hard-earned capital, and now we see things that are starting to put pressure to cause higher interest rates. And if that happens, that means if we don't hold them till the entire length, that we could actually lose money on the investment. So bonds, market prices of the bonds depend on a combination of factors: the credit quality of the issue, length until maturity, the duration, the current economic environment for interest rates, coupon rate, and then market liquidity. Now, bonds typically, you know, the whole bond marketplace are pretty liquid, but just because they're liquid doesn't mean you're going to get back 100% of what you put in, because a corporation might issue a new bond. So think about it like this. If they could turn around and issue a bond today at 6%, right? When the bond right now that you're currently holding at 4%, right? Why are they going to pay higher interest rate for the same $1,000? So that brings us to these three definitions: par, premium, and discount. Face value, an issue, price, and price paid if held until maturity. Premium means if we're getting above the par value. A discount means if it's selling below the par. So here's a graph that I think explains it. So if we had a $10,000 bond and that was done at issue and it was a 5% yield or a 5% coupon, the interest every year would be $500. That $500 is paid, like I said, every 6 months, $250. That's the income that it can generate, the yield, the milk cow that you'll see me talk about in the future. Now, if for whatever reason the market did place, you need to get out of that, you need to sell it, and the yield is a little bit higher. So we've seen yield going up and it goes to 5.55%. If I'm going to buy that bond from you to have the same attractiveness, I'm going to offer you a discount. So in order for me to get 5.5, I'm only going to give you $9,000, right? So the bond, as yield goes up, price goes down. So that's why it's less than what you paid for it, and there is a loss. And that's the point that I always caution against. Now, if the environment is that, hey, listen, you know what, interest rates are dropping. Now for that, I'm only going to get 4.55%. To get that $500 interest, you're going to still get that coupon. But in order for me to buy it from you, I now got to give you $11,000 for it. That's the seesaw effect that happens with bond yield. So I just, you know, I felt this chart helped explain it pretty simply. And I just wanted you to sort of get your handle on this, you know, the ever-changing up and down with yields and price. So the types of bonds: corporate bonds are issued by companies, right? The ability to pay is based on the earnings from the corporation. The assets may be used as collateral, and the interest is taxed as ordinary income. So that payment in the last slide where you got $500 would generate a 1099 INT, right? So you would get and have to pay tax on that money every year, depending on the environment that they were in. Obviously, if they were in IRAs or qualified plans, that's tax deferred, but taxes ultimately due. Now, Treasury bonds are issued by the Department of Treasury. They're issued to finance national debt. There's 4 types, right? Bills, notes, bonds, and tips. Bills are short-term, notes are 10-year, bonds are longer-term, and tips are for interest rate sensitive investments. Now, interest is subject only to federal income tax. So, you know, that might be a way for some bonds. You could say, hey, listen, I want to do that, but exempt from state and local taxes unless, you know, you get muni bonds, and we're going to talk about that. Now, muni bonds issued by state or local municipalities are issued to the fund public projects, like I was talking about before, GO bonds, general obligation, or revenue bonds. They're backed by either the revenue from the project, like say the Turnpike would be a good example. That's a revenue generating bond, or an issuing entity. The interest is tax-free in most cases, and maybe state tax-free if it's the state of residence. So my point is that municipal bonds sometimes for high net worth clients make sense, But again, just because they're tax-free on the federal tax return, it still could subject your Social Security to taxation. It starts to get really complex. So they're not always what they're cracked up to be, but obviously I run across a lot of folks that have these in their portfolios. And then if they're, depending on if they're trading in and out of them, because they owned let's say a mutual fund or a bond fund, right? There could be trading going on in there that could generate some taxable events along the way. So again, everybody's case is different, but on a high level, this is how they work. Now, other types of investments. So we talked about debt, and now we're going to go to the one, and it's going to seem like very rudimentary at this point. But again, I just felt it was worth going over first. So as I start to take us down a path of conversations in next week's presentation, we'll turn around and say owning and assets, types of assets would include, because again, in my 30 years, people will come in and say, hey, whether we're paying for college, I'm going to save my money here. I'm going to put my money here. This is my retirement plan. I've seen a lot. I wouldn't say I've seen it all, but I've seen a lot of strategies. And at their core, they all have pros and cons, right? So we're going to invest in stocks. Everything's fine until it isn't. And we're going to talk about stock ownership, mutual funds, right? Back in the day, mutual funds were all the rave. Everybody was in it because in order to have a basket of stocks, most people couldn't afford to have a well-diversified portfolio. So a way to be able to participate would be to pool with other investors in mutual funds. But over the last 20 years, I think a lot of spotlight has been put on the mutual funds and pulled back a lot of the layers. And quite often they're quite expensive. That's why you get those really thick prospectuses. And the other thing with mutual funds is that if the investment policy dictates and outlines something specific, they can't deviate, right? They're filing that with the SEC and there's no adjustment available. And then people will say, well, hey, I'm going to send my kid, I'm going to college, I'm going to buy a house on campus and we're going to have that. And that's going to be our retirement plan. And, listen, I love real estate. There's a lot of different ways to invest in real estate. One thing I've learned along the way is that, with real estate, they're not making any more of it, right? So if you're going to own it, remember that there's a lot of things that are going on there, both from a tax standpoint, from it's real property, right? There's costs involved with it. Then you have the liability factors, right? That's if you're going to rent it out and then we're going to have tenants, right? We always have to make sure that it's protected. And then let's just say you do build a portfolio and you have, now you're 80 and you go, well, now do you really want to be a landlord, right? So there's, again, pros and cons, commodities. Everything sounds wonderful. If you were to listen to a commodity trader, 20 years ago that oil was all the rage. You want to be in oil. Oil's gotten clobbered, right? I just don't think that there's any get-rich-quick scheme, but having commodities or at least being aware of where the marketplace is, they're all an underlying necessity to most investment strategies. But, if you're going to be a futures or a commodities trader, you better do your homework because it is complex. And then once you start talking about notes or contracts coming due, it could be a painful experience. And I think that's what a lot of people found out with the whole GameStop and the shorting, and they're shorting it and margin calls that were all going on in the last couple months. People that are day trading and trying to trade on margin with money that they don't have, just very, very risky. And we'll talk more about that. Tax deferred annuities, right? So annuities are another way that you can put money away. They typically are not sexy. They're not overly attractive because they're not designed to compete with stocks, right? Unless you're in a variable annuity. And I think most of you know that I'm not a fan. I think they're too expensive, but I think, annuities serve their place, but they have to be a part of an overall strategy. And then business, right? I think business, if you own a business and can build a business and have a business that is part of your overall net worth, I think is absolutely a great idea. But these are just, it's nomenclature, right? So all things we know. For the most part, I'm just going to talk about stock, right? So I can keep it on a high level. When you invest in an asset, you purchase an ownership interest, right? In return, you may receive a potential increase in the value of the investment, potential opportunity for dividend or distribution. That's the whole point, right? If I'm going to put my capital someplace to work, I want to get a return on my capital. There's no guarantees to your original principal, right? That's the risk, right? And then the ability to sell depends on the type of investment. And that comes back to liquidity. So if we go back to the slide before and we're talking about real estate, I'm going to be a real estate investor, and you turn around and you buy a couple pieces of property. Right now, real estate's hot, right? There's not enough of it, right? People are with COVID, they're moving out of the cities, they're buying, they're snapping up real estate, and you got to sleep somewhere. But if we back up 10 years ago, the market was flooded after the housing bubble burst. So, there is no, I think, one size fits all. And, economic environments do play have a place that we have to understand overall. How's it fit into your overall portfolio? But again, I'm going to talk about owning an asset, stocks. By owning a share, you're part of the business. The number of shares determines your total ownership. It can be public or private. I will caution, I have some experience in having some private equity holdings in the past, and they're thinly traded, or they're they're not real liquid. So, maybe sometimes it's a good idea, but sometimes, maybe things don't go according to plan. And now how do you get your capital back from that corporation? You're an owner. And until, I've experienced it firsthand, and I can see how it ties up your assets. And then they typically will trade on exchanges. US markets are typically open from 9:30 Eastern time to 4 o'clock. And that they're also after hours trading going on. I mean, trading now is it's global, and it's 24/7. But for the purpose of this session, the most common type of asset owned is a publicly traded stock. So there are some advantages: liquidity, capital appreciation. I should have put on there / depreciation. It could happen. You can lose money. So I think that, but let's be optimistic. Dividends, right? So that's the one thing that, depending on the type of stocks that you own, and you'll see me start to talk more about this in the future. Is it a growth stock? Is it a value stock? Is it a stock that was generated to be a milk cow, dividend? So we'll talk about that. Hedge against inflation, right? So this is where inflation hasn't reared its head of late, right? But I think that's coming. I think things will change. And I think if you went through the Jimmy Carter years and you saw the lines for gasoline, when things got tough, inflation was what? Double digits, 14%. I think my parents, when they bought their house in Edison, had a 14% mortgage. Right. So when you see that stuff, that's reality. It hasn't happened. And just because it hasn't happened in 30 years doesn't mean it couldn't happen again. And the stage is set for it to start to make an appearance. So the reason stocks are advantageous if inflation hits is because those are the vehicles that actually can outpace it. If we don't keep up with or surpass inflation, well, now we could have a problem where we lose buying power. And that's something we will talk about as well. So there are some disadvantages. Next slide. So no guarantee, no promises to repay the initial investment like bonds. Volatility, I think, is here to stay, right? We are in a news or headline environment where one comment, and I think the media just absolutely feeds on creating comments and headlines. I'll look at my iPhone in the morning, and I'll turn around and the market could be down 50 points, and you'll see a headline, stock slide on, and it's like, because they need to say something, right? I try not to listen so much to the headlines and the talking heads. But overall, part of what I think working with a truly seasoned advisor is managing emotions, managing expectations, having a strategy. So volatility is something that we have to just get our heads around and see how much in our overall portfolio we can handle. Lots of research is needed to understand the company. So if you're going to buy a stock, right, you're going to buy Coca-Cola, right? You need to go in and say, okay, what has their dividend paying history been for the last 30 years? Has it been consistent? Have they done it every year? Have they changed their president or chief financial officer? Is there any underlying lawsuits? Anything that could affect if you're going to purchase it? I'm not talking one share, but if you're going to build a basket of stocks and you say, hey, I want to own 1,000 shares of Coca-Cola and I'm going to commit $100,000 to that portion of that one stock, If that's your only stock, I would counsel against it, and we'll talk more about that in the future next week. But just understanding that research in today's world, there's a lot of information at your fingertips, and so that's important. So stocks are classified based on the size of the company. You'll hear me talk about on my monthly recaps, large cap, mid cap corporations, small cap. These are the size of the companies, not only from an employment standpoint, but their overall capital and market value. Geography, right? Are we talking about companies here that are US based? You'll see me talk, about emerging growth markets, right? Maybe China or developed countries, international, European nations, companies that are over there that maybe were leaders in the past, but might be struggling now, right? Sectors. So this is another term, right? So we want to be, when we talk about diversification, right now, financials seem to be a place to be. Healthcare, right? With all the money being dumped into for vaccines and virology, all of these things, I think on a go forward basis are looking optimistic. But energy got crushed because as soon as COVID hit, people stopped traveling. Right? This is why I was talking about the oil markets, right? Is that, the commodities sector, we just had an abundance. They stopped running out of places to be able to store the abundance of petroleum. So, but now maybe energy, and we've talked about wind and solar and different environments within a sector. So there's a lot of opportunity and a lot of, diversification available. So we'll talk more about that next week. Is that the appropriate strategy? How do we analyze? And that's why last week or, the week before when I had Mark on and we were talking about ARK, it's a boutique money manager, but they're very forward looking. And that's why I said, let me circle back to make sure we understand that it's not designed to be that this is where we think all, your strategies, all your investments should be, but it should maybe be a small percentage of, because I think there is upward possibilities there. So how the corporation utilizes earnings, their growth stocks, their value stocks, their dividend stocks, are they doing stock buybacks? Are they splitting? Are they trying to grow? All these things when you own a stock and you own a company are helping you to analyze how your money is being allocated amongst the different areas. So that's my story for this week. Hopefully, like I said, it wasn't too basic. And I know on its surface, I'm going, well, it's stocks and bonds. I know that. Most everybody can explain a stock, right? They say, yeah, I'm an owner of a company and I understand risk. Okay. Where I find people struggle sometimes is the bond arena, right? They know what they sort of are, but they really couldn't articulate it. So I always feel it's worth the time to spend some effort there. This is our call. I want to thank all of you for taking time out of your weekly schedule to join us here. Next week, we will talk about unsystematic and systematic risk and what that actually means to your overall planning going forward. I hope all of you are safe. If you need me, email me, have questions, reach out, and have a great day. Bye-bye.